studying your last two. I swim med when turned in. The staring down to mute. And can learn the pole that sunk he died.
When learning about Schedule 4, it's easy to think that every available tax loss should be used immediately. However, experienced tax preparers know that applying corporate tax losses is not just a calculation, it's also a planning decision. Whenever a corporation has available losses, the first question is not, how much loss do we have? Instead, the more important question is, which option provides the greatest overall tax benefit? In many situations, there are several possible strategies to consider. The first option is to apply the available loss during the current taxation year. If the corporation has taxable income now, using the loss immediately can reduce its current taxable income and lower the income tax payable for the year. The second option is to carry the loss forward. Instead of using it today, the corporation may choose to preserve the loss for future years. If higher profits are expected later, saving the loss could provide greater tax savings when taxable income is larger. The third option, if the corporation meets the applicable requirements, is to carry the loss back to a prior profitable year. By applying the loss against eligible prior year taxable income, the corporation may be able to recover taxes that were previously paid through a tax refund. Notice that each of these options follows the tax rules. The difference is not whether the loss can be used, it is when using the loss creates the greatest overall benefit. This is why professional tax preparation always includes tax planning. Rather than making an automatic decision, the tax preparer compares the available options, estimates the tax impact of each one, and then chooses the strategy that best supports the corporation's financial situation. You can think of the process as 4 simple steps. First, identify the corporation's available tax losses. Next, compare all available options, including applying the loss now, carrying it forward, or carrying it back if appropriate. Then evaluate which approach provides the greatest tax benefit based on the corporation's current and future circumstances. Finally, complete Schedule 4 using the strategy that has been selected. The most important lesson from this slide is that Schedule 4 is much more than a reporting form. It is a planning tool that helps tax preparers determine when corporate tax losses should be used to maximize their value. The key takeaway is simple. Good tax planning is not about using losses as quickly as possible. It is about comparing all available options and choosing the strategy that provides the greatest overall benefit for the corporation while keeping Schedule 4 accurate and up to date. Before applying corporate tax losses, experienced tax preparers ask a series of important questions. These questions help ensure that the corporation receives the greatest possible tax benefit while remaining fully compliant with the Income Tax Act. The first question is straightforward. What is the corporation's current year taxable income? Before deciding how to use any available losses, you need to know how much taxable income exists. This establishes whether there is income available to reduce during the current taxation year. The second question is, does Schedule 4 show any available prior year losses? Review the corporation's Schedule 4 carefully. Confirm the available loss balance and verify that the losses are still eligible to be applied. Next, ask, did the corporation pay income tax in prior profitable years? This question becomes especially important when considering a loss carryback. If taxes were paid in an eligible prior year, carrying back a current year loss may generate a tax refund instead of waiting for future tax savings. Another important consideration is the corporation's future. Are higher profits expected in future years? If the corporation expects significantly higher taxable income later, preserving some losses for those future years may provide greater overall tax savings than using them immediately. Now ask the key planning question. Which strategy provides the greatest overall tax benefit? Should the losses be applied this year? Should they be carried forward? Or, if eligible, should they be carried back? Professional tax preparation is about comparing these alternatives before making a decision. Finally, confirm that Schedule 4 will be updated accurately after the decision has been made. The amount of loss used and the remaining balance must be recorded correctly so future tax returns continue with accurate information. One of the most common beginner mistakes is automatically applying losses without first reviewing all available options. Professional tax preparers follow a structured process instead. They begin by reviewing the corporation's financial information and Schedule 4. Next, they analyze the possible tax outcomes of each available option. After selecting the most appropriate strategy, they document their reasoning and supporting calculations. Then they apply the chosen loss strategy to the tax return. Finally, they update Schedule 4 to reflect the revised loss balance for future years. Following this process creates accurate records, improves consistency, and supports better long-term tax planning. The key lesson from this slide is simple. Good tax planning begins with asking the right questions. Review the corporation's taxable income. Verify available losses. Consider both prior and future taxation years. Compare all available options. Document your reasoning, and only then apply corporate tax losses using the strategy that provides the greatest overall benefit. By developing this habit, you'll move beyond simply preparing tax returns and begin thinking like a professional tax preparer who uses Schedule 4 as both a compliance document and a valuable tax planning tool. Throughout this chapter, we've learned that Schedule 4 is much more than a form used to record corporate tax losses. It is an important tax planning tool that helps determine how and when those losses should be used to provide the greatest overall benefit to the corporation. Let's summarize the complete decision-making process used by professional tax preparers. The process begins by reviewing Schedule 4. Before preparing the current year's T2 return, always check the corporation's available loss balances and confirm that the information agrees with prior year tax records. Next, understand exactly what losses are available. Different losses may have different tax treatments and eligibility requirements, so it's important to identify the available balances before deciding how they should be used. Once the available losses have been identified, compare the available options. Would carrying the loss back to a prior profitable year generate a tax refund? Would applying the loss against the current year's taxable income provide the greatest immediate benefit? Or would carrying the loss forward create larger tax savings in future profitable years? Rather than making assumptions, compare each alternative carefully. The next step is to evaluate the corporation's current taxable income. Understanding the current tax position helps determine whether applying losses this year is beneficial. Then think beyond the current year. Consider the corporation's future expectations. If higher profits are expected in upcoming years, preserving some losses for later may provide greater long-term tax savings. After reviewing both the current and future tax situation, select the strategy that provides the greatest overall benefit for the corporation. Only after completing this planning process should the T2 return and Schedule 4 be finalized. Professional tax preparers also develop consistent working habits. They review Schedule 4 every year. They verify loss balances before preparing the return. They document their calculations and planning decisions. They compare carryback and carryforward alternatives whenever appropriate. They update Schedule 4 after every loss application. And before filing the return, they perform a final review to confirm that all calculations and assumptions are accurate. As you continue preparing corporate tax returns, remember the key ideas from this chapter. Schedule 4 is a valuable planning tool. Corporate losses can reduce taxable income and lower income tax. Sometimes carrying losses back provides immediate refunds. Sometimes carrying losses forward provides greater future tax savings. And accurate records ensure those benefits remain available in future taxation years. The most important lesson is simple. Good tax planning is not about using corporate tax losses as quickly as possible. It is about understanding all available options, evaluating both current and future tax consequences, documenting your reasoning, and applying losses in the way that best supports the corporation's overall tax position while keeping Schedule 4 accurate and up to date. By following these principles, you'll move beyond simply completing tax forms. You'll begin thinking like a professional tax preparer who understands that every corporate tax loss represents an opportunity to reduce taxes through careful planning, accurate documentation, and sound professional judgment.